Retail investors are outperforming mutual funds and hedge funds, and they've been doing so for many, many years, partially because mutual funds and hedge funds have massive fees. And most mutual funds are actually a scam because fees can be as high as 5% annually through many, many hidden fees, and yet most mutual funds do not outperform the indexes like the S&P 500. So I recommend never buying mutual funds. So why are mutual funds still relevant? Why do they still exist? It's because they have massive lobbyist initiatives and they pay a lot of money to CNBC and other business channels through advertising, something I'll never do. I'll never accept sponsors. The reason I won't accept sponsors ever is because I always want to stay true to my students as my customer and my only customer ever. And so I recommend doing your own investment research if you have time. If not, I recommend buying ETFs instead. So ETFs stand for exchange traded funds, and they have fees that are often more than 90% lower than mutual funds. And they actually outperform mutual funds by about 90%. So how do you get started with ETFs? Well, let's go together to finance.yahoo.com, and don't ever pay for any investment research. You can even get the Financial Times for free, which I'll show you in a second. All right, so let me go here to top screen here. Go to finance.yahoo.com. Okay, so the first ETF I want to pull up here is the S&P 500. I'll do this very quickly. So this ETF allows you to buy all 500 stocks in the S&P 500. Those are 500 stocks that broadly represent the U.S. economy, and I'll talk about global ones in a second. The first thing you want to do is you want to go to Profile, okay? And then you want to scroll down to see what the expense fees are. And you can see right here the fees are 0.09% per year, which is nothing, because a lot of mutual funds charge up to 5%, including hidden fees, okay? And also, these ETFs don't turn over the portfolio much unless there's a rebalancing, meaning when a new stock is added to the S&P 500. Okay, that's a big deal because that means you don't have taxable gains. And I'll explain that in a second from a tax perspective. So you look here at the expense ratio. Then what you can do is you can look at the holdings if you want to. And this is fascinating because this will tell you what's in the S&P 500 and what the American economy is based on. And so here's the 12 segments here. The biggest of which is technology, no surprise, at 23%. The second biggest is financial services. Then if you scroll down, you can see all the stocks that make up the S&P 500. Now let's talk about an international one. So if you want to invest in Brazil, and God bless Brazil, my heart goes out to them for all the COVID issues there. But in Brazil, where I've invested a lot in the past, the first thing you do, as I mentioned before, is you look at the profile, okay? So this fee is a little bit higher at 0.59% per year. We can also look at the breadth and depth of the Brazilian economy right here, where you see it's basically, first off, we've got a lot of natural resources, okay? Then financial services. And this is very similar to the Canadian ETF as well, EWC. And I'm going to show you some commodity ones in a second very quickly. So we go here and we look at the Canadian ETF. Okay, it's called iShares MSCI Canada. It's Morgan Stanley Capital Index. The first thing we do always is we go to Profile to see what the fee is. The fee is 0.51%. Okay, and you want that to be way under 1. In terms of the holdings, it's very similar to the Brazilian economy because it's very natural resources rich. Canada, you see natural resources here, energy, etc., and then financial services. Okay. Now I want to show you how to invest in gold, ticker GLD, which usually does well when the markets are not doing well. It's a flight to quality. I buy gold in size when the market is crashing. And it was my biggest position back in 2008 when the world was falling apart and the markets were in free fall. So the first thing we do here is we quickly look to see the expense ratio, which is 0.4%. You can see right here. You can also buy sector ETFs. So for example, there's the OIH, which is the Oil Services Index. So if you want to invest in drilling companies, you can invest in this. The first thing we always do is we go to look at the expense ratio, the annual fees. And so in this case, it's 6.35%. And then we can go and look at the holdings. There's Schlumberger, ticker SLB, Halliburton, Baker Hughes, and all these drilling companies. The best ticker though is RIG, Transocean. I love that one. Okay, so that's how you invest in ETFs, or that's what you look for at least. And I'll never be sponsored by anybody, but I want to recommend a certain ETF company to check out. It's called Vanguard. And let's go there very quickly together. Let's go to investor.vanguard.com. So here on this website here, Vanguard, you can actually look through many different ETFs they have. They have bond ETFs, they have stock ETFs, every type of ETFs you can think of, and the fees are very, very low. If you can't access Vanguard in your country, then what I want you to do is I want you to call the 5 largest banks in your country, and I want you to ask them to transfer you to their retail brokerage division and ask them how you can buy Vanguard ETFs, which have fees way below mutual funds. And that's one of the reasons why they outperform mutual funds is the low fees. Okay. And if you work at a company where the retirement investment program makes you buy only funds from large mutual funds like Fidelity, then you can ask if you can buy Fidelity's ETFs if they exist and if the fees are as low as Vanguard. Last thing I'll say when it comes to ETFs is another reason why they're better investments than mutual funds is because mutual fund managers, what they do, and I lived it, I worked in the hedge fund industry for years. Mutual fund managers, what they do is in the fourth quarter of each year, they chase performance because their bonus is based on how well they do. And when you chase performance, you're buying and selling stocks a lot. And when you do that, even if you make money, you realize a taxable gain. Because what happens is countries will try to reward you for being a patient investor, meaning if you own a stock for more than a year and you sell it, you pay much less capital gains taxes. So the bottom line is, please don't ever invest in mutual funds. They are an absolute scam. Instead, what I want you to do is invest in ETFs.